Evening, everybody. Hey, welcome along to the webinar this evening about buying your first investment property. So I'm Greg, and I have Leon here with me. So we're going to jump in a second and start going through a bit of information that we've got. If you've got any questions throughout, then feel free to chuck them in the questions section. There's a bit at the bottom will say ask a question, and we'll jump onto them at the end and go through those for you. So let me share my screen here, and we will get underway. Awesome. Cool. So, yeah, looking at buying your first investment property. So just a little bit of information about ourselves so that you kind of know who you're dealing with. So, as I said, my name's Greg. I bought my first property with my wife when I was 24. It was our family home. We built a lifestyle property in 2018. So I've been in here for about 4 years now. I'm a owner here at My Mortgage, one of the shareholders, and brought my first investment property at 37. I've had a bit of a weird kind of background. So did a sports science degree, was a teacher for a while, jumped into some software sales in a few different industries, and obviously now a mortgage advisor as well. So it's given me a pretty interesting background to come into this industry, which has been cool. I'll let Leon introduce himself as well.
Thanks, Greg. Tough act to follow. Yeah, welcome everyone. Really looking forward to lots of questions today, and Greg and I are keen to help out where we can and answer them. So don't hesitate to post things into the comment box. So a bit about me. So I bought my first house when I was 26. More recently, I've delved into property development with a 7-lot subdivision. Just completed that. Took 2 years longer than I wanted and cost a bit more than I'd hoped. So lots of learning throughout that process, and now looking for my next property investment opportunity, and currently based in Christchurch. So yeah, looking forward to helping you guys, and I'll hand over back to you, Greg.
Awesome. And one thing Leon sometimes leaves out of his little bio is that he used to work for a bank, and we're okay with that. But he's seen the light and come and joined the mortgage advice team here at My Mortgage, so which is awesome. Awesome. Thanks, Leon. So yeah, let's just jump into some questions, go through some stuff around buying your first investment property, what that might look like. And it's just some of the really basic information. Now, for some of you, you may be well down this track and you've done a lot of reading and all that sort of thing. Potentially, maybe you've already got your first property and you're looking to do another one or something like that. Yeah, bear with us if there's some stuff that we've already covered. No doubt that you'll get some things out of it as well. So the first question to always ask when you're looking about investing is where are you at right now? So we're going to cover a few of these things. So first one is equity. So potential what equity you might already have in properties that you already own. We'll cover that in a bit of detail. Obviously, income is really important and more important now than ever. So we'll talk a little bit about income. Family situation or just your life kind of age and stage is really important. We'll cover a little bit about that, and also other options. So we understand that property investment isn't always not only option. So we want to just talk about that a little bit as well. So let's jump into some equity questions. This is something that people are always asking me about. Hey, how much equity do I have to put into a new property? What can I use? Those kind of questions. So let's run through some stuff. So equity is essentially the money, the value of your property that you have versus what maybe is in a bank loan. So for example, if you have a $800,000 house, then and your mortgage is $400,000, your home loan's $400,000, then you have $400,000 worth of equity there. So that's kind of how that is all broken down. And then the next question we always get is how do I use it? And that's a really interesting thing. There's a few different ways. So we'll talk in a little bit about how you might structure your lending with banks. But essentially, there is always some equity you have to keep in your house. So you can't use 100% of it. And the reason for that is the banks want to make sure that if property prices came down, then you would still have some equity in there. We never want to get to that point, which is what happened in the global financial crisis, especially in the US, where people's home loans were more than the value of their houses. So we've got some restrictions that have been put in place. We'll talk about those in a little bit that mean that you have to keep some equity in there, and then the rest of it you can use if your servicing allows you to. So we'll talk about servicing in a little bit as well. So here's an example. You've got your own home. It's worth $800,000, and your debt on it, your home loan, is $450,000. Cool. Fairly kind of common numbers across the industry we're seeing at the moment. So your loan to value ratio, and these will be talked about a lot. You might have heard people talking about LVRs, which just means loan to value ratio. So what's the loan on your property versus the value of your house? So in this situation, it's about 56%. Now, the way to work that out, if you're, math maybe isn't your strong point, just take how much your mortgage is and divide it by the value of your house, and that will give you a decimal point, times that by 100, and you get the loan to value ratio. Cool. So at the moment, there's limits from the Reserve Bank about how much, what the LVR can be, the maximum LVR can be for your home. And at the moment, that's 80%. So that means that you can use 80% of the value of your home. You've got equity that you could use. You need to keep 20% equity in your home. And the only exception to that is with some for first home buyers and some builds. There's some options there, but it's pretty limited. So that's where the 80% number comes from on your own home. So you can work out then, in this situation where we've got 800,000 worth of valuing our property, we've got debt of 450. The 80% number becomes 640,000. So that's the maximum we could borrow. So in this situation, we have usable equity of $190,000. Okay. So that's equity and some LVR stuff. So next one is servicing or income. So servicing is how the banks look at you in terms of what you can afford to repay and when it comes to lending. So the first thing they always look at is income. So let's just look at some income kind of streams here, because there is a few differences. So obviously the first one is salary. You've got a job, you get paid, and you get PAYE tax comes out of your salary before you get it. Your company pays that for you, and you've got a salary. You've also got wages, so potentially you might get paid an hourly rate, and sometimes you work a minimum of 40 hours, sometimes you might go to 45. Busy weeks, you might 50 hours a week, and so you've got wages. Potentially you're self-employed, and that's an interesting situation that we do quite a lot of lending for. And if that's the case, all we're generally looking at there, you might pay yourself a wage, which is great, and then you'll have some net profit as well in your financials. So that's a source of income that we can absolutely use. Government benefits, things like working for families. Sometimes if you're on a sickness benefit, or one person in a couple is on a sickness benefit, or something like that, we can use those. And rental income. So if you've got rental properties, we can obviously use income from the rental property, and then boarders and flatmates as well is another source of income that we can use. There's always dividends and other things like that as well. But there's kind of a bit of an overview of some of the income that we can use when it comes to servicing a loan. So we've got income, and why does servicing matter? Sometimes we have situations where people are like, I've got all this equity, but the bank won't give me any money. Why is that? And essentially, since about 2014, there's been a piece of legislation called the Responsible Lending Code, and that dictates that to the banks that they have to make sure that every person they lend to can afford to repay that lending. And so they are under pretty strict kind of guidelines around who they can lend to. And if you don't have the income to be able to service that lending, or you've got other things that are going to take up a lot of your servicing, so other debts and things like that, then they can't lend to you. And that's where sometimes second tier lenders can come in. We're not going to talk about second tier lenders too much tonight, but that's where potentially, if your servicing is not so great, there might be some options there for you. But it all comes at a cost. So that's why servicing matters. And we find this a lot as people get towards retirement age. Potentially they're working less, their income's dropping, but they've got really good assets, so asset rich and cash flow poor. That's sometimes when the servicing thing can come and become a bit of a problem. So a few things to consider when you're thinking about servicing. So obviously general expenses, so how much you're spending on food, things like, my food bag and HelloFresh, those kind of things are generally more expensive. How much you're eating out, all those sorts of things come into it. Business debt, and this is a question we get asked all the or some things that come up and we say, hey, look, we've got this business debt over here, and people say, yeah, that's my business, that's not me. Well, if you're the director of that business, you're liable for that debt, and so then that debt has to be taken into account. There's a few things we can do around that in terms of the interest being added back in, but as a general rule, if you've got business debt there, it's considered a liability, and the servicing needs to be done for that as well. Childcare expenses, obviously looking after kids in terms of daycare and those sorts of things are really expensive. And so we often see that a decent chunk of people's income is taken out in childcare. So, and then, you would have heard a little bit about the Triple Cfa, which is some new legislation that came in December. The media have jumped on this, looking at how many coffees you've had that week, and how many times you're eating out, and those sorts of things. We're expecting some of that to be rolled back early June. We're not quite sure where that's going to land, but we don't think it's going to be the silver bullet that some people maybe think. So they asked, we do still need to look at your expenses. We do still need to look at the last 3 months and go through your bank statements to find out what you can borrow. So yeah, just be aware of that there's some things that might pop up, some questions that you might get asked. The other thing actually that's just come in recently is insurances and rates, and this is quite relevant for investment properties. It used to be that the insurance and rates on your investment properties didn't really count as an expense, whereas now all the banks are looking at that. So sometimes it's worth looking at your properties and actually checking your insurances, seeing if you can go somewhere and get the same quality product for cheaper. If you're wanting any, we've got a really great insurance partner that we work with called Initiative. And they do great online quotes and online application for insurance for houses. You can put in your address and they'll give you a quote. So if you are in the market for house insurance, that's a good option. Another thing that is kind of causing some confusion is rental scaling. So say you have a property and it brings in $500 a week rent. The bank is going to scale that rent, and they'll scale it at all sorts of different levels. Some of them are scaling at 80%, some at 70, some at 65. And what that means is they'll only attribute to you the lower amount, that scaled amount, to your income. And the reason for that is they're obviously wanting to make sure for repairs and maintenance you have enough extra, and also if there's empty periods where potentially your property isn't rented, isn't tenanted, you have some extra cash flow there as well. So they'll scale that down. So people often will say, well, my mortgage repayments are $500 a week and my rent's $500 a week, so it works. It's like, yep, two things there. They are scaling your rental income down to maybe $400 or $380 a week, and they're actually testing your lending at a higher amount as well to make sure that if interest rates go up, you can still afford it. So even though it covers itself, or as some people might say, wipes its own face at that basic level, there is actually some other factors at play there. So there's some rental scaling that happens. And that where they're testing slightly higher, that's what we call test rates, servicing test rates. And that's where we've actually seen the biggest change in the last few months. When those interest rates that were down at that 2.5% mark, we were seeing the test rate being at 5.2. So they were checking us at that 5.2 mark to make sure that we could repay any lending. And now we're seeing that rate to be about 7.3. So pretty massive change there in terms of testing what we can service. And so that's obviously comes into servicing as well. So it's not quite as simple as, hey, I earn this much a week and my mortgage is less than that, so everything will be okay. So when it comes to investment properties, one of the conversations around at the moment is, do I buy a new property to have as an investment property, or do I buy an existing property, so a property that's already been built? So let's talk through those quickly. So what is an existing property? Existing is a property that has been built, might have been built for 5 years, might be built for 50 years. It's an old code of compliance, so an old title, old code of compliance, and that is considered an existing property. And existing properties at the moment, the maximum loan to value ratio is 60%. Okay, so if you were just going out and you didn't have your own home, you didn't have any equity, and you were just going to buy a rental property, and you brought an existing rental property, you would need a 40% deposit, and the bank would give you the other 60%, and that would equal the 100% that you need to buy that property. So that's where that 60% loan to value ratio comes in. A few things to just consider when it comes to existing properties. So one is maintenance. Obviously, buying an older property, there will be potentially more regular maintenance. You don't really have any comeback if there's something wrong with the property, or if it's getting old. The roof leaks 2 years after you've purchased it. That's just old houses. That's what happens. So something to take into account. The second one, healthy homes. If you're putting tenants into a property, it needs to meet healthy home standard. That's a standard by the government to make sure that we're giving Kiwis dry, warm, and insulated homes. So lots of older homes don't actually meet those healthy home standards. And if they do right now, the healthy home standard is always getting improved. And so, for example, at the moment, you don't have to have double glazed windows in rental property, investment property. But in the coming years, we're expecting that maybe the government might make that a rule. And so then there will be a cost to do that as well. So currently it's around heat pumps and insulation and things like that. So that's just something to take into account. And the other one is tax exemption. This is not me giving you tax advice. I'm not an accountant, and you should definitely seek tax advice. We'll talk about that in a bit. But as of last year, the government have started to remove the tax exemptions, things that can be exempt from tax around the interest of investment properties, if those properties are existing properties. So what we're seeing is a few of our investment clients starting to pull out of some existing properties and move into some new properties. Reason for that, so new property is anything that has a new code of compliance. And we are seeing a few interesting things here. So there's some new legislation that's come out on that. And I was talking to an accountant the other day, and she was saying that if a property has been, a house has been picked up and moved and put on the same bit of land but moved, that becomes a new code of compliance, and that can actually be looked at as a new investment property. So some interesting things going on in that space. The good thing with new investment properties, you can borrow up to 80% of the value of that new property. Generally, there's lower maintenance. You can build things out of brick that requires no maintenance. Most people suggest that they shouldn't need much maintenance for the first 10 years. Healthy homes, all new builds have to be up to the healthy home standards. There have been some times that some of the numbers haven't been quite right, and there's need to be some extra stuff added in for healthy homes. But make sure you chat to your builder about that if you are looking to buy brand new. And the tax is, there's some tax benefits as well around buying a brand new property. And they're going to last for, at the moment, with the current legislation, for 20 years. So a property keeps those tax benefits for 20 years. Even if you've brought a property that is new or was new and someone else had it, the tax benefits actually stay with it now as well, which is great. So there are some benefits there around those new properties. So as I mentioned before, if you're looking at any of these, buying your first property, getting some good tax advice is really important. Find an accountant who knows property. Not all accountants are property experts, so make sure you find an accountant who knows property, and someone that you can connect with in terms of that they get where you're trying to go. So not every accountant is going to be great for your situation. So there's some really good accountants out there who are giving really good advice, not just, doing your books, but also giving really good advice about this sort of thing. Last thing here on new versus existing is the Brightline Test. So the Brightline Test got brought in a few years ago, and it's had a few different iterations. But at the moment, if you buy a investment property, so the existing investment property, one that's been built for a number of years, if you sell it within 10 years, you have to pay tax on the profit. So if you buy it for 500,000 and then in 5 years later you sell it for 600,000, you have to pay tax on that $100,000. Whereas with a new property, if you buy it and then sell it within the first 5 years, you have to pay tax on it. So it's actually it's half the length of time if you need to sell that property, that you don't need to pay tax on the proceeds of it or the profit that you make on that property. So Brightline, again, talk to an accountant about it, but there's some interesting things going on in that space as well. Brightline is interesting in that 10 years for existing, it used to be 5, and before that it was 2. So depending on when you bought your property, it may or may not fall within that. And also if you and lots of people do this, they buy their first home and then later on they build or buy another home for themselves and turn their own home into an investment property, there's some differences in terms of Brightline rules for that as well. So talk to an accountant and get really good advice about that before you make any decisions, because the difference, selling this property, if you're having to pay, I don't know, a third of it back in tax, that can make a massive difference to maybe what you're going to try and do after that. So getting good advice there is really important. So just quickly, buying process. So getting pre-approved right now is really important. So make sure that if you are thinking of doing something in the investment space, chat to your mortgage advisor, come see us at My Mortgage, and we'd be happy to get you pre-approved. So just find out what you can actually do. Nothing worse than going down the track of, hey, I'm going to find a property, I'm going to find a builder who's going to build me an investment property, all those sorts of things, and then finding out that we either can't service as much as we wanted or things like that. And there's been a lot of changes in the last 6 to 12 months. So even if you've been approved, say last year, it's a good idea to get pre-approved before you get too far down that track. Obviously, finding a property, as I said, there's lots of ways you can do that. An existing property, you might trade me in through an agent. There are buyers agents out there who'll be looking for investment properties for you. That could be an option. There's developers who are actually building properties for investment. So the investment property I've purchased recently, that was through a building company, and they're just building investment properties. And then, or you could be finding a bit of land for yourself and doing it that way as well if you're looking to build. Making an offer, if this is your first investment property, but you've purchased before, you know how all this works, but getting a good solicitor, so a good lawyer and a good accountant to help you with this process, but a solicitor will help you through that. Meeting those conditions. So at the moment, with the property market, just becoming a bit more of a buyer's market. So as a buyer, as an investor, there's some really good deals out there for you, and you've got time, which is great. So you can meet those conditions. You can have a 10-day finance condition, and generally your offer will still be accepted at that. So you can, or a builder's report or due diligence or whatever you want. Meet those conditions. You can go unconditional then. One thing that often comes up here is if you've got an existing property and then you're going to buy an investment property using the equity in your house, then you still need a deposit for the day you go unconditional. And normally that deposit is 10%. So if you were buying an investment property for $600,000, you would need $60,000 on the day you go unconditional to pay to secure that property. And then when we get to settlement, you obviously pay the rest and the bank pays the remainder as well. So some people have that cash available. So you might have some savings that you're wanting to put into this investment property. Cool. You can use that for your deposit. Some people might have family that they can borrow that money off for the short term. So, hey, we're going unconditional today, settlements in a month. Mum and dad, grandma, can I borrow that money? And in a month, I'll pay it back once the bank, gives us the money for the settlement. And then sometimes what we need to do is actually do a quick top up on your existing lending and get that money for the deposit and then use that on unconditional day. So it's really good to know straight up what you're going to do there, because the last thing we want to do is to get to that unconditional day and for you to go, cool, where's the money for my deposit? And for us to be like, oh, we thought you had that or you could access that. So good to have that conversation straight up front as well. And then obviously we get to settlement. During that period, you might have a property manager that is organising. We'll talk a little bit about that in a second. A property manager to organise tenants and all those sorts of things. Maybe you need to do some work on the property once you get to settlement, all of that sort of stuff. So a few quick FAQs, things we get asked about a lot. So the first one is splitting banks. So essentially that's where, hey, I have my own home. My own home is with this bank, Bank A, and then I'm going to buy an investment property, but I don't actually want Bank A to have security over that. I want to take that to Bank B. And the reason you might want to do that is because when you sell one of these properties, if the same bank holds them as security, any proceeds from that, any money extra that you have left over, say you sell the property for $800,000 and your mortgage is only $400,000, that $400,000, if you have extra debt with that bank, they can demand that you use that money to pay off the debt. Whereas if they're with separate banks and you sell your own home and you have $400,000 from selling that property, this bank has no say over what you do with that money. So then you can use that and go and do whatever you want. It's kind of an important thing. An example, I had a client and they had their own home, heaps of equity in their own home. They'd bought a property in another town for one of their parents to live in. Their parents were getting older, so they brought them that property. Then we brought them another property for the parents that was actually closer to their house. So they had both their property and the property the parents were currently living in with one bank. When we bought the next one, I said, hey, let's move this to this bank, because then it's just out here on its own, and no one's got any security against it. And then they moved the parents over to this property and sold this property over here. When they sold that property, this main bank said, oh, well, we're going to take all the proceeds of that. And they said, no, we need that to do some renovations over here. We've got some plans to do on our house and put in a pool and a few other bits and pieces. And the bank said, no, we hold security over all of those properties, so you need to use those funds to repay that. Now, we ended up, doing a full new application for them to this main bank and saying to the bank, hey, look, they can still afford all of that lending and all of that sort of stuff. And we managed for them to keep the proceeds from sale. But if it had all been split across a different bank, then it wouldn't have been a problem. So definitely something to consider in terms of splitting banks. Just because your home might be with Bank A doesn't mean that your investment property has to be there. And sometimes it's actually quite nice to have them split so that lots of people choose to pay down their own home as quickly as possible and leave their investment property on interest only or something like that. So, which leads nicely on to interest only. So you might hear that people are saying, pay down your own debt, like the debt associated with your own home first, and leave your investment debt so on interest only. Interest only is obviously where you just pay interest. You don't pay principal, so the amount of your loan is not coming down, so you're just paying the interest. It's become less important recently because of these the tax benefits around that. It used to be that you could claim back the tax on your investment properties, but you couldn't on your own home. Because that's starting to be phased out, it's not as big a thing. But obviously, if you're buying a new build, then it is. So that would still work. Most of the banks will give you interest only on an investment property, not a problem. Generally, they'll limit it to 2 or 3, maybe 5 years maximum. And what they'll be looking at is, if we're saying the loan term is 30 years and we're going to have interest only for 5, they want to check, can you afford that loan over 25 years? So they're basically taking those 5 years of interest only, taking them off, going, can you afford it over 25 years? So then there becomes a servicing conversation. Can you actually afford the loan over 25 years? What we do see occasionally is investors who will have their property with this bank. They'll have 5 years interest only, and at the end of those 5 years, they'll refinance to another bank, get another 5 years of interest only, and they'll just keep doing that. Capital gain of their property will go up, and the loan amount will basically stay the same. So there's an option to do that there as well. So property management versus self-managed. So when you have tenants, you can obviously manage it yourself. So that might mean you put out an ad on Trade Me for tenants, you get all the tenants' information in, and then you decide who you're going to put into your house, and then you manage it. You do the checks every 3 months and all those sorts of things. Versus a property manager where someone else does that all for you. They charge you a fee. Generally, it's a percentage of your rental income. So say your rental income is $500 a week and their fee is 8%. Then they would be taking, quick maths, $40 a week for that service. In my opinion, I would never manage a property myself. I would always have a property manager. There's so much legislation. The legislation is always changing, and I'm too nice, and I would probably let my tenants get away with anything. Whereas having a property manager gives, as an investor, gives you a comeback. So if something goes wrong, then you have someone to go back to and say, hey, what happened here? Why did this happen? Why was there, a drug lab in my house? Or why was there this damage? Why was there an animal there when I'd said no animals? And that's their job, is to manage that stuff. And also, if you are if there's things that need doing on your house, on your investment property, the property manager will organise that for you as well. So that's my opinion. There's lots of people out there who self-manage and have done it really well. But I'd say have a look at your skill set and see what you're able to do when you make that decision. Is the $40 a week worth it for the potential stress and anxiety that might cause? And final is local area versus another region. So I had good conversations with some of my clients about this. So they live around me in the Waikato, and so they're saying, "Cool, I want to, buy and invest property in this town or close to here or whatever." And then for me, I've brought my investment property in another city, and there's a few reasons for me wanting to do that, and so it's always a good idea to look at that. Yes, you might know your local area really well. You know the good parts of town you want to buy in, you know the builders potentially, you know where the good schools are, that sort of thing. But then the flip side of that is if it's too close, sometimes that can be a bit of a problem. And I've heard stories of landlords who drive past their investment properties and get angry because the lawns aren't done or the gardens don't look right or whatever, and then that gets them a bit angry at their tenants, and then they're on their property manager. And so sometimes it's almost one of those like out of sight, out of mind situations as well. So just good. Obviously, you want to do your research and figure out what you want in an investment property. There's lots of kind of numbers and figures and all that sort of stuff you can do in terms of returns and negatively geared properties and all those sorts of things. But a bit of a high level in terms of your local area versus another region. So real quick, why do you use a mortgage broker? So we're free. We don't charge you. We get paid by the banks. We give you tailored advice. It doesn't matter. We don't care which bank you go with. We go with the bank that's going to give you the best deal and give you the best money and do what you want. There's lots of options both in banks and how to get into a home, and we can talk through those with you. So generally what we find is that people who work at a bank, they look at it through their bank lens. So, hey, this is my bank. This is how we do things. As mortgage advisors, we can look at it from a whole bunch of different angles and find the best way to structure things for you. And we have a really strong team of professionals at My Mortgage. So lawyers, accountants, property managers, even building companies, things like that, who are doing lots of this sort of stuff that we can point you in the right direction and get you connected up with them, insurance companies, things like that. And most importantly, we're on your team. We want you to buy a house or buy your investment property or do that next thing. We obviously don't work for a bank, so we want you to be successful and to get where you want to go. So in terms of what's next, we'll jump into some questions in a second, but feel free to flick me an email, greg@mymortgage.co.nz. Happy to answer any questions, happy to look over your situation. We can jump on a quick Zoom call and see where you're at right now and make a bit of a plan. It could be that you're like, yep, you want to buy right now. It could be that this is a 6-month, 12-month, or maybe 2 or 3 year thing. We can obviously get you pre-approved, which would be a really good way to get a clear indication from the banks of what you're able to do, and then we can give you advice on the process as well. So kind of talk through all of the stuff we've chatted through tonight, but in specifics to your situation. So let's jump into some questions. Leon, are you there?
I am, Greg. Just bringing the video back up.
He's coming
thanks
back.
for that. I love the honesty about being a nice landlord. I definitely would like to in one of your houses. You get away with murder. So feel free to add any questions into the comment chat, folks, if you've got any burning ones. We've had some come through from a few people registered earlier in the week. First one is just around second tier lenders, Greg. So I'm not sure you wouldn't really touch on this too much. Someone said they've heard about second tier lenders funding up to 80% LVR on existing investment properties. Can you just touch on that?
Yeah, sure. So so we've got a few second tier lenders. So basically, just to kind of explain second tier, so we've got our main banks. So that's kind of the big five: ASB, ANZ, BNZ, Westpac, and Kiwi Bank. Under that, we kind of have minor banks: TSB, Cooperative, SBS. They kind of sit there. And then we have what's called second tier lenders. So there's one called Select, there's one called Resimac, there's Advanti, there's a whole bunch in there. There's about 27 that we generally deal with. Obviously not all of them all at the same time. And the second tier work really well when there's something that's not quite right. So if maybe your income situation is a bit funny, or maybe the asset you're trying to buy, the property you're trying to buy is a little bit funny. Maybe you've had some credit issues, things like that. One or two of those second tier lenders, because they're not under the same restrictions as the banks, one or two of them will actually do investment properties at 80% LVR as well. Now, there's obviously still some other things, it's that classic starred terms and conditions do apply. But there is some options out there for 80% LVR for investment properties that's existing as well. So just because the banks are doing 60%, we can do 80%. And that's really helpful because they'll do your own home, so what we call owner occupied at 80%, and they'll also do your investment property at 80%. So if the amount of equity you have that's usable isn't quite enough, then we could look at that as an option. The interest rates are generally slightly higher, but they're not too bad at the moment. Some of them are pretty close to bank rates. There are obviously some second-tier lenders that are way, way higher, and we tend to stay away from them, but there are some options out there.
Nice. And we've got another one here. We've got some people that are looking at buying either a turnkey or building a new investment property. They're a little bit worried about the time it's going to take to actually get the project completed. They're reading the news about delays and materials and that sort of thing. Yep. You're talking to builders all the time, or you're helping other clients with it. What are you seeing out there at the moment? Is it something that's definitely achievable and people would sort of get into it sooner rather than later? What do you think?
Yeah. So yeah, really good question. So yeah, obviously we are seeing supply chain issues at the moment. I had a meeting with a large local building company on Monday, and they said, like GIB is really hard to get for finishing their builds. But if you've got a really well-planned builder, things are still coming in the time that they're saying it's coming in. And the main thing I would say is at the moment, you probably want to be building with a reputable building company who's got a bit of history behind them and got some, got some funds behind them probably. As we get into a slightly softer market, it'll be interesting to see kind of what happens. And the concern is obviously that if a few projects get delayed and things like that, then there could be some issues for some building companies. But anyone we've been working with, and the main question everyone has always been having is what happens if I sign a contract at this price and then when I come to build, it's going to cost this much to build. And I haven't seen a single property developer increase their price between when you've signed and when you've ended. I'm sure there's some that have done it, but none of my clients have had that happen. So that's probably the main concern, especially with turnkey, as Leon mentioned before. Turnkey being you sign a contract, you pay a deposit up front, they build the house, and then you pay the rest on settlement. Those ones there, I haven't seen a single one. Even when there's been 30% increases in building costs, I haven't seen any of them increase in value. So definitely still a good option. There's still a lot out there, and I actually think there'll be some bargains out there with builds coming up where potentially they've planned way ahead and got a whole bunch of builds ready to go, and then maybe the buyers aren't quite there. So there definitely could be some options in that build space. One thing I'd just say there as well, some of the different builds, so obviously you've got apartments, you've got townhouses, and then you've got standalone kind of properties. Apartments have different loan to value ratio numbers, so good to check based on their size. I think it's under 50 square meters for some banks. They'll only lend up to 60% on, and even if they're brand new. And then townhouses are generally still, they'll go to 80% if they're brand new. And then obviously existing, standalone properties, not existing, new builds that are standalone, and they'll go to 80% as well.
Awesome. Thanks, Greg. We haven't had anything come through the chat. So
I have one more.
Last seconds there if there's no. All right, I'll hand over to you.
I have one more thing I forgot to mention at the start. So probably to go kind of zoom out a little bit from I've got quite micro in terms of specifics, but from a macro level is what are you wanting to achieve with investment? So for some people, they're looking for quite short-term gains. And if you're looking for short-term gains, that's totally fine. But that's a different kind of property investment than someone who's looking to buy for the long term. So getting that really clear in your mind is important. And the reason for that is if you're buying a property and maybe the rent doesn't quite cover the mortgage repayments, especially at the moment as interest rates are a little bit higher, then all of a sudden you could be like, oh, well, I'm just in it for making some quicker money, and so that could be a problem. Or you don't want it to affect your lifestyle, so you don't want to be adding money in, so you need the rent to cover it. That's going to determine where you buy, because there's not as many places now where you can get rent to cover the lending. And flip side being, but if you're in it for a really long term, then it's like it actually doesn't matter where that kind of sits. I'm happy to chuck in a bit of cash each week at the moment until rents increase. I'm happy to, I don't know, the type of property you buy might determine that as well. So have a really good think about what's important to you, what you're wanting to achieve. And really similar is at the start I mentioned about what you're in it for, and that might be that property investment isn't actually right at the stage of your life. So for whatever reason, maybe property you can't buy a property right now, but there are some other things you can invest in, things like shares and managed funds and all that sort of stuff. Based on what I know recently, maybe stay away from crypto. Leon can give you a little bit more information about that, no doubt. But there's definitely other things that you can invest in as well. So that's just always a conversation to have, is what's important to you, what's important to your family, what's important to your stage of life, those kinds of things.
Yeah, that's a really good point, Greg. Thank you. You've been great tonight. You've covered us some really good points. There's no other questions, so I might leave to you just to finish the wrap up. But to anyone else there, really look forward to helping you. Greg's got his details in there for you to book in a meeting, and best of luck. And hopefully 2022 is going to be your year to get onto the investment property ladder. All the best.
Yeah, thanks, Leon. As Leon said, touch base. I'm happy to chat through your specific situation, can break down your numbers so that you know exactly how much equity you've got, look at those income and servicing requirements, that sort of thing, and help out. So feel free to flick me an email, greg@mymortgage.co.nz, or you can jump onto our website, fill in the contact form. It comes straight through to me, and happy to help you out there. Enjoy the rest of your Thursday evening for those of you watching live, and look forward to helping you in the near future. Have a great evening. See ya.
Thanks, everyone. Good luck.